Good afternoon, everyone, and thank you for joining us for another one of Avant Garde Trading Securities free educational trading webinar. We are thrilled to have you here this afternoon and thrilled to welcome our guest presenter, Ken Keating. He is a principal at the OCC of Investor Education and one of the instructors at the Options Industry Council. We've had him here many times, and each time is better than the last, and he is here today to talk with you all about valuing options, moneyness, and pricing models. And Ken's going to go into more detail about this topic. Ken, are you with us?
I am, Natalie, and welcome everyone. You want me to go ahead and share my screen?
Sure thing, Ken. Why don't you go ahead and do that? And while you're doing so, I will remind everyone who is joining us live today in the Zoom room, since you are here live, you have the opportunity to ask Ken questions at the end of his presentation. So if as we're going through, you note a question that you have for him about the material, please write it down and then type it into the chat box or the Q&A box, and I'll get those questions over to Ken at the end of his presentation, and he can address those time permitting. Ken, I can see your presentation. It looks wonderful. So whenever you're ready, feel free to start.
Great. So all you can see is the title slide right now, correct?
Correct.
Perfect. Okay. All right. Well, thank you. And thank you for that introduction, Natalie. And thank you for joining us here today. As Natalie mentioned, my name is Ken Keating, and I'm going to be presenting today's presentation on valuing options, moneyness, and pricing models. So just to give you a quick background on myself. So I've been at OCC for roughly about 5 years. But before coming to OCC, I was a professional options trader for well over 25 years. So I started out as a floor market maker on the floor of the Pacific Coast Stock Exchange in the early 90s. I then moved myself to Chicago, where I traded as a floor market maker as well as a floor specialist. I then moved back to California in the late 90s, where I ran risk management desk for my trading firm, who at the time was one of the largest privately held market making firms at the time. I then ended up going back to the trading floor, working as a floor market maker and as a floor specialist. I worked for a capital management firm for many, many years, managing a very large portfolio of options, trading off-floor vol arbitrage, and also working for myself for many, many years as a sole proprietor. So currently I work at OCC, helping individual investors such as yourselves to better understand both the risks and the benefits of exchange-listed options. So speaking of the risks and benefits of exchange-listed options, anybody who's considering trading options should thoroughly read and understand the characteristics and risks of standardized options, which you can obtain by visiting us at optionseducation.org to download a free digital copy. Or if you prefer a physical copy, you can always reach out to your broker or any exchange on which options are traded. In order to simplify the calculations used today, commissions, fees, margin, interest, and taxes have not been included. And lastly, any strategies discussed here today are strictly for illustrative and educational purposes. All right, here are some of the trademarks and logos that you will see throughout the presentation. This is simply to make all the lawyers at OCC happy. A little bit about OIC. Who exactly is OIC? So OIC, the Options Industry Council, who I work for, we are effectively the education arm of our parent company, OCC. So OCC, as many of you know, is the Options Clearing Corporation and is the world's largest equity derivatives clearinghouse for exchange-listed options, as well as the foundation for secure markets in the United States. So OCC started clearing and settling options when options started trading in 1973 on the Chicago Board of Options Exchange. OIC started in 1992 as a collective to better educate the public both on the risks and the benefits of exchange-listed options. And we do that primarily through our website, optionseducation.org. There you'll find our complete free online education. You'll find an online course. You'll find podcasts, videos, and additional webinars on just about any subject that you can think of. Now, the pride and joy of the OIC is our investor education desk, which can be reached at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options related questions. So this too is a free service. And the reason why we can offer you this free of charge is because we are fully funded by our parent company, OCC. So we just want individual investors to be better educated, understanding the product, and hopefully using the product responsibly and profitably. So if you ever have questions, you can shoot us emails at this email address, but just know that we are not registered advisors. We cannot talk to you about specific stocks. We can't talk to you about setups. We can't direct you on trades, but we can talk to you about option theory, optionality, option strategy, also how a corporate action may impact your options position. So if you trade long enough, at some point, you will be presented with some type of corporate action, whether that's a company merger, a stock split, both a forward and reverse split, a rights offering, a special dividend maybe. These all affect options contracts differently. So if you ever have questions regarding how a corporate action might impact your options position, you can always reach out to us, and we are always more than happy to help you out. Okay, with that out of the way, let's get started. So today, we're going to be talking about options pricing, okay? So essentially, I'm going to be talking about how options prices are created. We'll then be looking at intrinsic and extrinsic value of an options price. We'll then be looking at the moneyness of options. We'll look at the concept of put-call parity. We'll look at implied volatility as well as option pricing models. So time permitting, as Natalie mentioned, Q&A you can enter your questions during the presentation, and at the end of the presentation, I'll bring back Natalie and we will try and answer some of your questions live. So we have a lot to go through, so let's get started. So options price creation. So what factors affect an options price? So when you pull up your favorite stock on an options chain and you see all these different colors and you see multiple bids and multiple offers and prices are moving and you see different months and you ask yourself, well, who's making all these prices? Well, the prices that you see on any given time are certainly not random, okay? You can kind of think about the prices that you see at any given time as the crowdsourced pricing of the options for that particular product at that particular time. So anybody who's participating in the options market, whether it's an individual investor, an institutional investor, a hedge fund, a pension fund, a bank, a market maker like I used to be, anybody who's buying and selling options is having an effect on the price of those options, okay? So when you see a bid and offer, okay, the also known as the NBBO or National Best Bid or Best Offer, what you're seeing is the published best market at the time, at that time in place. Okay, so it's essentially the consensus of anybody who's participating in that market. So in the end, what is an option ultimately worth? Well, it's really only worth what somebody's willing to pay for it. Okay, so we as traders use pricing models as a guideline, but those models don't make our decisions for us. Ultimately, it's really just a tool to come up with a theoretical value for an option, okay? So we'll be looking at some option pricing models later, but like the old adage goes, garbage in, garbage out. If you put bad inputs into a pricing model, you're going to get bad outputs, okay? So pricing models are simply a guideline, but ultimately, it's the forces of supply and demand that override any theoretical value that might exist for a particular option. So we'll get into that in a little bit. So supply and demand. So this is going to be a little Econ 101. So simply put, option prices are no different than any other product out there. So if you have high demand chasing a lower supply, you're naturally going to result in higher prices. So if you have a lot of people in the market and they all want apples and there's a very low supply, well, they're going to bid up the price of apples. And in this case, apples end up getting bid up to about $1 a piece. You see the same thing in the grocery store now that we have higher interest rates. We've been experiencing some inflation in the economy. I mean, every time I go to the grocery store, every 2 bags of groceries cost me over $200. It's just crazy. The price of meat, the price of eggs, the price of milk, everything has gone up. So it's no different than the options market, where when you have higher demand chasing a lower supply, it's naturally going to result in higher prices. Okay, well, when you get higher prices, that's going to attract suppliers, or in the case of options, option sellers. So as more and more, as the prices get higher and higher, it incentivizes people to come into the market and become option sellers. So when you have more sellers than buyers, okay, naturally that's going to result in lower prices. Okay, it's no different than any other product out there. Okay, so in this case, now we have a high supply and a low demand, and naturally in this case, the price of apples goes from $1 down to 50 cents. So it's a very simple concept, and it really is no different than in the options market. So when we talk about an options price, okay, many times traders speak of something called fair value. So what exactly is fair value? Well, fair value is, you can consider fair value the midpoint of what's known as the bid-ask spread. So let's look at an example. Let's just say we have a stock, it's trading 48, maybe it's got a month to go, and we're looking at the February 50 calls, okay, that they're just slightly out of the money. They're $2 out of the money. And the market on these particular calls is $1 bid, offered at 120, 100 up, meaning right now the market's telling you that there's 100 contracts to buy for $1, and at the same time the market will sell you 100 contracts at $1.20. Okay, that's the bid ask spread. So when I was a market maker, this is what I would do all day. I would determine a fair value for this option. If I thought this was a fairly priced option, I'd say, okay, well, the option is fairly valued at roughly 110. So I'm going to make a market around fair value. I'm going to say, well, I'm $1 bid offered at 120. Me, myself, maybe I'm 25 up, meaning I'm willing to buy 25 contracts for $1, and at the same time, I'm willing to sell 25 contracts at $1.20. So whether I buy the option or sell the option, in theory, I'm making what's known as theoretical edge. Okay, so if I buy the option for $1, I'm buying it for 10 cents less than fair value. Or if I sell the option for $1.20, I'm selling it for 10 cents more than fair value. Okay, so when market makers, people who trade professionally, are buying on their bid and selling on their offer all day long and hedging it with stock and other options, what they're doing is they're building this mountain of what's known as theoretical edge. Okay, that is what is a market maker's profit. Okay, that bid ask spread. Now, it's simply a theoretical profit. It doesn't mean that's exactly what the trader is going to make. But in theory, over time, if you buy on your bid and you sell on your offer over time, most likely you're going to make money. Okay, so in this case, fair value is $1.10. The market right now is $1 bid offered at 120. But let's just say I look at this market and I say, well, I don't want to pay 120, but I'd be willing to pay 105. Okay, so I'm going to put in a 105 bid for, say, 10 contracts. So I put in my 105 bid. If they trade, great. I just bought them for a nickel less than the fair value of 110. If they don't trade, the new market's going to be 105 bid, my bid, for 10 contracts, offered at 120. So it's 10 by 100. Okay, I'm trying to buy 10 contracts, and there's still 100 contracts offered at 120. My bid has single-handedly moved up the price of these options slightly. Okay, so where fair value before was $1.10, now fair value is the midpoint of 105 and 120, and it's 112 and a half. Okay, so I have single-handedly, with my little bid, pushed up the value of these options ever so slightly. Okay, so we're going to look at implied volatility and how that relates to options prices, but you can kind of think of it like as as option prices move higher, the implied volatility is moving higher as well. Okay, so so simply put, that's just a little representation of how the market works in terms of supply and demand. So now let's look at an option's intrinsic and extrinsic value. Okay, so if an option is in the money, it's going to have two components. It's going to have both intrinsic and extrinsic value. Okay, so let's look at a 50 level call with stock trading for 55. Okay, so a call is the right to buy 100 shares on or before expiration at that strike price. Well, stock's trading 55. So buying the right to buy shares at 50 is already $5 in the money. Okay, maybe this call is trading for $6 with say a month to go. So this option would have $5 of intrinsic value. In other words, the difference between its strike price and the stock price. That extra dollar is comprised of extrinsic value. And extrinsic value is comprised of time, interest rates less any dividends, and always the wild card, and we're going to be talking about this later, implied volatility. So let's just say, for an example, this 50 call is trading for $6. And let's say a huge order comes into the market to buy 10,000 of these contracts. Well, some are going to trade 6, some will trade 610, 620. That demand for options is going to push the price up. So let's say this big order gets cleaned up at $7. Okay. And for this example, let's assume that the stock is trading exactly at 55 still. Okay. Well, what's changed? Well, the stock price hasn't changed. It's still 55. The strike price certainly hasn't changed. It's the 50 level call. Time to expiration really hasn't changed. Maybe 10 minutes has gone by. Interest rates and dividends hasn't changed. What's changed is the extrinsic value portion of this option. So before this trade, this option was trading for $6. It had $5 of intrinsic value and $1 of extrinsic value. Now, with the option trading for $7, it still has $5 of intrinsic value. That hasn't changed. What's changed? Now this option has $2 of extrinsic value. And since nothing has really changed except volatility, because the option's extrinsic value has gone from $1 up to $2, the price has gone up by $1, we can also infer that the implied volatility of this option has also gone higher. So when option traders talk about implied volatility, and you know now they have these shows that are dedicated to options on TV, and they talk about implied volatility or vol, all they're really talking about is the level of options prices. So naturally, as implied volatility goes higher, you can infer that option prices are going higher and getting more and more expensive. And if implied volatility is coming lower or getting crushed, you can infer that option prices are getting lower and lower and lower and getting less expensive as they go lower and lower and lower. But we'll get into that a little later in the presentation. All right, so kind of in review. So an option is going to have, if it's in the money, it's going to have both intrinsic value and extrinsic value. So an intrinsic value is the in the moneyness of that option, the difference between the strike price and the security price. Extrinsic value is essentially anything over intrinsic value, okay? It's the extrinsic value or time portion or time value of the option. And it's this time value that decays. So you know how they say options, every day they become worth less and less and less as you get closer and closer to expiration. Well, options do decay. It's the time portion, time value portion, or the extrinsic value of the option that decays, not the intrinsic value. Okay, so when people sell options, people like to sell options, covered call writers, credit spreads, whatnot. What they're really targeting is the extrinsic value portion of the option, because this is what decays, not the intrinsic value. At expiration, an option is really only worth its intrinsic value because there's no time remaining. So if you ever exercise an option or get assigned, only the intrinsic value of that option is either received or delivered. Any extrinsic value at that point is lost. Okay, so just remember at expiration, there's no time value left. An option is either one of two things. It's either in the money or it's out of the money. Only two things can happen at expiration for an option. Okay, so in the money calls and puts have both intrinsic and extrinsic value. Sometimes it's easier to visualize this way. At the money, okay, calls and puts have no intrinsic value. Their premiums are comprised of nothing but time value. So if stock's trading for 50, the 50 level calls and puts have no intrinsic value. Whatever they're trading for is comprised of 100% time premium. And just like the out of the money options, they don't have any intrinsic value whatsoever. Their premiums are comprised of 100% time value. Okay, so let's look at the moneyness of options. So a call is considered in the money if its strike price is below the price of the stock. So in this case, stock is trading for 50, and we have, in this case, Jan, Feb, and April 50 level calls. Okay, so in the money calls would be any strikes below 50. Okay, in this case, the 40 and 45 level calls. So the 40 level calls, if I buy the Jan 40 calls, it's the right to buy this stock at 40, even though it's trading for 50. Well, this option is going to be $10 in the money. It's going to have at least $10 of premium and a little time premium left in them. So it's going to have both intrinsic and extrinsic value. The at the money options are the options that trade closest to where the stock is trading. So right here with the stock trading 50, the Jan, Feb, and April 50 calls would be considered at the money options. Out of the money options have strike prices above the stock price when we're talking about calls. So in this case, the Jan 55, Feb 55, April 55 calls, as well as the 60 Jan, Feb, and April 60 level calls. So with the stock trading 50, these Jan 60 calls are probably not trading very much. Okay, remember, it's the right to buy stock at 60, even though it's trading 50. Well, you need a big move in the stock for these options to take on a decent amount of value. But if all of a sudden you buy these little out of money options and stock makes a run from 50 to 60 really quickly, well, these options are going to take on a tremendous amount of value. They're going to go from being an out of the money option to an at the money option. Okay, so and this is why people love trading options. It's the leverage they afford. So you can buy the right, but not the obligation to buy or sell 100 shares of stock without actually having to buy the shares themselves. Okay, so it's the leverage that they afford you, and this is why people love trading options. Now, when we talk about the at the money options, okay, the stock doesn't have to be exactly, in this case, I know it's for simplicity purposes, we put the stock at 50, and these 50 level calls would be the at the money options. If stock were trading for 49, the 50 level calls and puts would most likely still be the at the money option. So it's essentially the options that are trading closest to where the stock is trading are always considered the at the money options. Now, puts, on the other hand, are just the opposite. So a put is considered in the money if its strike price is above the stock price. So if the stock trading 50 again, in this case, where the 55 and 60 level calls were out of the money, now the 60 and 55 level puts are considered in the money. Because remember, if I buy a April 5th 60 put, it's the right to sell stock at 60, even though it's trading for 50. This option is going to be $10 in the money, is probably trading for something more than 10 because it's going to have both intrinsic and extrinsic value. But these options, for the 60s are already $10 in the money. The 55 levels are $5 in the money. Now, the at the money options is the same thing as with the calls. It's the options that's trading closest to where the stock is trading. So in this case, the Jan, Feb, and April 50 puts would be considered the at the money options. And a put is considered out of the money if its strike price is below the stock price. In this case, the 45 and 40 level puts would all be considered out of the money options. So let's look at an example. So we have stock XYZ trading 210, 30 days to go to expiration. And we see various call strikes. Okay, so let's just look at the 190 level call. So with the stock trading 210, the 190 calls are trading for $22. Well, we know that's the right to buy stock at 190, even though it's trading for 210. We know this option is $20 in the money. And if it's $20 in the money, then if $22 is what the call is trading for, we know that $2 of that premium is extrinsic value and the other 20 is intrinsic value, okay? Because these two have to add up to where the price of the option is trading for, okay? The 200 level calls are $10 in the money, and we see that they're trading for $13.65. So we know that they're $10 in the money. So if we know that it's $10 in the money, they're trading for $13.65. The remaining $3.65 is what's known as extrinsic value. The 210 level calls have no intrinsic value. Their premium of $5.10 is comprised of 100% time premium or extrinsic value. The same with the 220 and 230 level calls. Okay, so and as you can see, the options that have the most amount of time premium are always going to be the at the money options. They always have the most amount of time premium. Now, the options that have the greatest amount in overall notational time premium are going to be the at the money further dated options. Okay, because if I buy in this case, say a 210 level call a year out, it's probably gonna cost me a lot more than $5.10. Okay, because I'm paying for time. Okay, so the more time in an option, the more time premium you're going to be paying for that option going forward. Now, puts, let's look at a put example. So we have XYZ stock trading 46, 30 days to go to expiration, and we see various put strikes. So if we look at the 48 level put, we see it's trading for $4.40. Well, it's the right to sell stock at 48. Right now, stock's trading for 46. This put is $2 in the money. So if it's $2 in the money, then we know that the remaining $2.40 of premium has to be extrinsic value. The 47 level put, it's trading for $3.92. This option is $1 in the money. If it's $1 in the money, then the remaining time premium, $2.92. Because remember, these two, the intrinsic and extrinsic value has to add up to where the stock, the options are trading for in the marketplace. Now, the at the money options are the 46 level puts. They're trading for $3.42. This premium is comprised of 100% time premium, as well as the 45 and 44 level out of the money puts. And once again, you can see that which option has the most amount of extrinsic value or time premium. It's the at the money options here. All right, so now let's talk about a concept known as put call parity. So put call parity is essentially a concept, and it describes this relationship between calls and puts. So just know that calls and puts that share the same strike in the same month have a direct relationship to one another. So if I know the value of the put and I know the value of the stock, I can infer what the value of the call is without looking at the market. If I know what the value of the call is and I know what the value of the stock is, I can infer what the value of the put is. We'll look at things called synthetics, but if you can combine two of these sides of this triangle to come up with the synthetic equivalent of the other. I can combine calls and puts and come up with a synthetic stock position. So once again, it's that idea that calls and puts that share the same strike in the same month have a direct relationship to one another. We used to have a saying on the floor where traders would say calls are puts and puts are calls. They're no different from a trader's perspective because you can turn one into the other just by converting it with stock or hedging it with stock. And we'll look at some synthetic examples in the next few slides. But because of this relationship, it holds various financial instruments in check, and it allows the market to be priced somewhat efficiently. Okay, you're not going to see a lot of pricing irregularity. So let's look at a really basic example. And if there was an irregularity in the market, one was really cheap and one was really expensive, the market would, buy the cheaper one and sell the more expensive one until those prices got more in line. So kind of like this very basic example, let's just say we have two markets, market A and market B. Market A is selling apples for $1 a piece, and market B across the street is selling apples for $1.50. Well, if apples were completely fungible and you can buy and sell them at will, okay, what's going to happen? Well, people would naturally buy apples in market A for $1 and sell apples in market B, netting a 50-cent profit. Okay, that's an arbitrage. Okay, basically profiting from price differences in identical or similar markets in different marketplaces. Well, what's going to happen? Well, this is naturally going to push up the demand for apples in market A is going to push up the price from $1, say maybe up to $1.25. And the selling pressure in market B is going to push the price down from $1.50 to say $1.25. So at $1.25, we would say that the market is cleared and now it's efficient. Market apples are trading for the same price in market A as they are in market B, and there is no longer any arbitrage. Okay. Now, in this day and age, with the fact that we have high frequency algorithms that are trading in the market, computers that are keeping these markets somewhat, the put call parity example, in check, you're not going to see a lot of pricing irregularities. And if there were some irregularities, these high frequency trading algorithms would trade those irregularities back into place so quickly you would never be able to take advantage of them. Okay, so if you all of a sudden pull up on your option screen and you think you see an arbitrage opportunity, you got to ask yourself why that is, and it's usually for a very good reason. It's either one, due to some type of corporate action, or two, maybe the stock is hard to borrow and the puts trade at a premium to the call values, and it appears that there's an arbitrage there, but it's actually not an arbitrage. It's actually being priced into the cost of carry of that stock. This is actually another conversation for another webinar. But in a hard to borrow situation where everybody and their mother is trying to short stock, there could be a premium for the puts over the calls, and in that case, you might see an arbitrage, but it doesn't really exist because that's getting priced into the cost of the carry for that options position. So let's look at an example where put call parity is maintained. So we have stock trading for 99. And in this example, we have the 100 strike call trading for 4 and the 100 strike put trading for 5. Okay, so in this case, if I were going to buy the 100 strike call for 4, it has roughly a 50 delta, meaning that it's right at the money, and it probably has a delta of right around 50. I could turn around and sell the 100 strike put against it for $5, netting me $1 credit. Okay, 4 minus 5, it's $1 credit. By selling this put, I'm actually getting long another 50 deltas. So by buying the call, I get long 50 deltas. By selling the put, I get long 50 deltas. That's being long 100 deltas. That's the same synthetic equivalent of being long stock at 99. Okay, and why is that? Well, remember at expiration, if let's just say I got assigned on my short put, okay, maybe stock's trading at 99 and I do nothing. Well, my 100 level call is going to expire worthless. I'm going to get assigned on my 100 level put. I'm going to buy stock at 100. But remember, I put this whole structure on for $1 credit. I'm effectively long stock from $99. If stock, say, closed at 101, well, my 100 level put would expire worthless. My 100 strike call would be in the money. I would exercise it, and I'd be effectively long stock from $99. Remember, I'd be buying stock for 100, but I took in $1 credit when I put this position on. Whether I buy stock for $99 or buy the call for 4, sell the put for 5, in this case, it's the same thing as buying stock for $99. Now let's look at an example. In this case, we would say that the market is fairly priced. There is no arbitrage. But let's look at the second example. Now stock is trading for 100, and the 100 strike call is trading for $4, and the 100 strike put is trading for 5. Now, this is more for an example purposes. You're never going to see this in the market because, once again, computers would trade this discrepancy back in line so fast you'd never really be able to take advantage of it. But this is more for an example purposes. So in this case, put call parity has been violated, okay? Because in this case, I could buy the 100 strike call for 4. I could sell the 100 strike put for 5. That's $1 credit. I'm synthetically buying stock for $99. I could turn around and sell real stock for 100 and net $1 credit and lock in $1 profit. Okay, that's called a reversal. When you buy real stock and sell, I'm sorry, it's called a reversal. When you buy synthetic stock and sell real stock, that's called a reversal. When you buy real stock and sell synthetic stock, That's called a conversion. Okay. But, once again, what's going to happen in this case? Well, because the options are mispriced, demand is going to push the value of these calls higher, and sellers are going to push the value of these puts lower. Okay. So let's just say at $4.50, if the call's trading for $4.50 and the put's trading for $4.50, now if I buy the call for $4.50 and I sell the put for $4.50, that's even money. That's the same thing as buying stock for $100. In that case, now the equilibrium would be restored. But let's just say I was able to buy the call for $4, sell the put for $5. That's $1 credit, and then sell stock for $100. Okay. At expiration, once again, if I get a sign on my short put, I'm going to buy stock at $100, but I took in $1 credit. I'm long stock from $99. If I sold real stock at $100, I'm locking in $1 profit. On the flip side, if I bought the call for $4 and sold the put for $5, that's still $1 credit, and I exercised my call, I'm still going to be long stock from $100, but now I took in $1 credit. I'm effectively long at $99. I sold stock at $100. Either way, whether I exercised my call or got a sign on my put, I'd lock in this $1 profit. And once again, this is strictly for theoretical purposes, but this is an example where how put call parity, if it got violated, the market would trade it back in line, and in most likely scenario, the call would end up trading for roughly about $4.50 in this case, and the put would end up trading for about $4.50 to keep this relationship in line. Okay, so put call parity. So here is what are known as the synthetic equivalent. So like I said before, if you know the three sides of that triangle, if you know the value of the two sides, you can figure out the third side. So when I was trading on floor, I would have these formulas memorized, because once again, calls are puts and puts are calls. You can turn one into the synthetic equivalent of the other just by converting it with stock or another option. So once again, synthetic long stock is if I buy a call and sell a put at the same strike in the same month, that's the same thing as synthetically being long the stock. And I'm not counting dividends or interest rates. I'm just looking at the relationship by itself. Synthetic short stock is when you buy a put and sell a call, same strike, same expiration. That's the synthetic equivalent of selling stock short. So if I buy one put, sell one call, that's going to be the equivalent of selling 100 shares of stock short in this case. A synthetic long call is when you take a long stock position and pair it with a long put. So if I buy stock at 100 and I buy the 95 level put against it for protection, okay, the out of the money put, that's no different than synthetically being long the 95 level call outright. The synthetic short call is if I sell a put and sell stock 1-to-1. Okay, if I sell one put and 100 shares of stock, that's the same thing as synthetically shorting the equivalent call on the other side. If I buy a call and sell 100 shares against it 1-to-1, that's the synthetic equivalent of being long a put. Okay, so if I buy the 110 level call and sell stock at 100, that's the same thing as being long the 110 level put synthetically. And the last example, if I buy stock and sell a call against it, well, yeah, it's probably pretty familiar to most people. That's known as the covered call. If I buy stock at 100 and I sell the out of the money 120 level call against it, okay, that's the covered call position. A lot of people put on this position to create an income stream on the long holdings that they hold. That's the synthetic equivalent of being short a put. Okay, so if I buy stock at 100 and I sell the 120 level call against it, that's no different than being short the 120 put naked. So, it's kind of funny. I was talking to an individual at a party once, and he was telling me, I said, so what are your favorite option strategies? And he said, well, I'm pretty conservative. I like putting on covered calls for the income. I said, oh, okay. I said, how do you feel about selling puts naked? And he said, well, God, I'd never do that. I'd never sell puts naked. That's really risky. Well, the funny thing is, this is exactly what you're doing when you put on covered calls. It has the same risk profile because what's the risk in a covered call? You buy stock at 100, you sell the 120 call, the stock falls apart. You're going to lose on the long stock position. Your risk in a covered call position is in the long stock position. It's no different than if I were short the 120 put naked, okay, in this case. My risk is still to the downside. So it has the exact same risk profile as the covered call. So anyway, that's neither here nor there, but just this is how these relationships work. That whole, if you know the call value of the call and the value of the stock, you can infer the level, the value of the call, and vice versa. If you know two sides of that triangle, you can figure out the third. All right, so now let's talk about implied volatility. So I always tell people this now, implied volatility is probably the most misunderstood but crucial aspect of trading options. So implied volatility is a forward-looking metric, and it's the volatility assumption at which an option is currently priced. So once again, when you put into a pricing model, options pricing models have various inputs. And one of the inputs that you put into a pricing model is the implied volatility option, okay? So if all of a sudden you put in, let's say you buy or sell an option today, and it's in your position, and you look at tomorrow, and all of a sudden you're up or down a bunch of money, and the stock's in the exact same spot. Well, if you can't figure out why you're making or losing money on a particular options position, more often than not, the reason lies with changes in implied volatility. So as I mentioned at the beginning of the presentation, when traders talk about implied volatility or vol, all they're talking about is the level of options prices. So once again, as option prices get bid up higher and higher and higher, you can infer that implied volatility of the option is moving higher and higher and higher because people are willing to pay more for the same option. The volatility assumption for that contract is moving higher. And likewise, on the downside, if there's more sellers than buyers, that's naturally going to result in lower prices, and which is going to affect the implied volatility and move the implied volatility lower. So prices of options, it's the consensus of all market participants, okay? And basically, who determines an options price? Everybody who's trading that option or participating in that options market is having an effect on those options prices. And once again, it could be individual investors, institutional investors, hedge funds, pension funds, banks, market makers, anybody who's participating, buying or selling options is having an effect on those options prices. So how does implied volatility affect options prices? So as I mentioned before, as implied volatility increases, both call and put prices will naturally increase, basically because that if it didn't, then once again get back to that idea that calls and puts that share the same strike in the same month have a direct relationship to one another. So if all of a sudden there's a huge call buyer and the price goes from $5 up to $6, well, the price of the corresponding put has to increase by $1 as well to keep that put call parity relationship in line. So once again, calls and puts that share the same strike in the same month have a direct relationship to one another. So as implied volatility increases, it affects both call and put prices the same. As implied volatility decreases, both call and put prices will naturally decrease by the amount of the volatility decrease for that particular month. All right, so now let's look at pricing models. So pricing models are essentially just mathematical formulas that traders use that are tools to help us come up with a fair value for an option. Now, they don't make our trading decisions for us, but they can remove the emotion from the pricing, okay? So once again, the prices of any options at any time are always subject to a lot of unforeseen variables, and the biggest of which is changes in supply and demand, which directly affect implied volatility. So here are all the inputs that go into a pricing model. They're the stock price, the strike price, implied volatility, time to expiration, and the cost of money, interest rates less any dividends. When you put all those parameters into an options pricing model, you're going to get theoretical values or call and put premiums. Okay. So once again, getting back to that old idea that garbage in, garbage out, if you put in bad pricing, bad inputs into your model, you're going to get bad outputs. Okay. But, once again, at any given time what a stock price is trading for. At any given time, what strike price you're looking at. At any given time, you really know how much time is left till expiration. And for the most part, the cost of money. This is the wild card. This is why implied volatility is the wild card, because it's always changing based on the supply and the demand for options. And this is what traders are always trying to solve for. And it's always moving based on the supply and the demand for options. So the most famous of the pricing models, and there's a bunch of different pricing models, but the Black-Scholes model, which started in 1973 by Fisher Black, Myron Scholes, and Robert Merton. This is the model. And, I consider myself pretty good in math, but when I look at this formula, it just makes my head hurt. Okay. But just like you don't need to know how a combustion engine works to be able to drive a car, just know that, the models that run on the back of your trading platform are running, they're the engine that are driving these models. And the Black-Scholes model is the most famous of all the pricing models. And it really revolutionized options trading, okay, at the time in 1973. But it did have certain limitations, okay? So the Black-Scholes model did a really good job of pricing European style options. In other words, options that could be exercised only at expiration. It didn't take into account early exercise. So most of the options that trade in the United States these days are American style options. And that means that they can be exercised on or before expiration for whatever reason the long holder wishes. And typically the only reason somebody would ever exercise a call option early is, say, for a dividend, okay? But the Black-Scholes model didn't factor in early exercise and dividends very well. It didn't really factor in changes in implied volatility. We know that volatility is always changing. It assumes that it doesn't factor in changes in short-term interest rates. We know that interest rates change, and it does not factor in commissions or transaction costs. Okay, so this is what is known as a log normal model. So a log normal model assumes that stock prices can't go below zero, and typically they go higher. So it's a rightly skewed model. It assumes that the options, that the markets are efficient. We know that sometimes the markets aren't necessarily efficient. And we know the direction of the market or individual stocks is not always consistently predictable. So there are other models that were developed. An extension of Black-Scholes, known as the Cox-Ross-Rubinstein model, which is one of the models that I used to use when I was training, was developed in 1973. And this is what's known as a binomial model. So a binomial model basically does take into account early exercise and prices in dividends a lot better than the Black-Scholes model. So where Black-Scholes does a good job of modeling European style options meaning options that can only be exercised at expiration. So examples of the European options are, say, the SPX, the options that trade on the S&P 500, the NASDAQ, the big NASDAQ options, the Russell, the VIX, things like that are considered European style options. Most X stocks and ETFs are American style options. So, the Black-Scholes model doesn't do a great job at modeling American style options, but the Cox-Ross-Rubinstein model does. And it does account for early exercise and dividends. So this is known as a binomial model. So what this does is it takes a price point between now and expiration. It assumes, like, if a stock's trading for 100, it assumes the stock could just as equally trade 100 and a penny as well as $99.99. It can either trade up or down. And it builds this tree of potential outcomes, either up or down, between now and its expiration. Okay, so it essentially calculates an options values at each of these identified levels. and it discounts the options price by the risk-free interest rate. So this is an example of an options calculator, and this is the calculator that you can use. We have a whole suite of tools on our OIC website that you have access to for free. You do have to sign up for a free account, but once you have a free account, you do have access to this full suite of tools. And this is actually our new, it's kind of an upgrade to our old calculator, but this is an options calculator. So what you do is, you in this case, you put in your favorite stock, and you can change obviously all the parameters here, on the left, the stock price, the strike price, the expiration, implied volatility, interest rates, any dividends. So when I pulled up this example, this particular stock was trading for 176.38, and I was looking at the 177.5 strike with 32 days to go to expiration, modeled at a 44.2 volatility with an interest rate of about 5%. So the calculator says, well, fair value for this option is $9.05. The fair value of the put is $9.42. And as you can see, it has all the option Greeks below it, okay? Like the delta for the call, the delta for the put, the gamma, theta, vega, and rho. So let's just say I modeled this option and I'm interested in buying this option. But then I pull up on my options screen and I see that the option is really trading for $10. Okay, well, I modeled this option. It says the calculator says this option's worth $9. Why is it trading for $10? Well, some of the parameters on this side of my equation have to be off. Well, I know that the stock price is right. I know that the strike price is right. Time to expiration is right. My interest rate is right. Well, it's probably my volatility assumption, okay? So another way you can use this calculator is this little box down here at the bottom. You can put in the options price. So if I see the options trading for $10, I can put in the options price, and it's going to spit out what the correct implied volatility is. So really, with all the parameters here on the left, correct, and this option trading for $10, the implied volatility of this option obviously has to be higher. In this case, it's 49.1. So if I went in this calculator and I change this implied volatility of 49.1 from 44.2 and hit go, my call value be worth $10 in this case, okay? Now, let's just say I'm bullish on this stock and I buy this option for $10. And now you can kind of use this calculator as somewhat like an option simulator as well. So what if I say, okay, I want to model this option and say, okay, stock price, I want to know what the price of this option is. The stock price trading 184.38. 12 days have passed of time. There's 20 days left in the contract, but 12 days have passed. The implied volatility went from 49.1 down to 47. My interest rate hasn't changed. What's my option worth? So with all these parameters, with the stock up, in this case, it's up trading 184, volatility in a little, and 12 days of time have passed, the option that I paid $10 for is in theory worth about $12.36. And once again, you can use this calculator almost as an option simulator to run a lot of what if positions. What if the stock goes up $5? What if the stock goes down $5? What if it goes up $5 and the implied volatility goes down 3 points? All these what if scenarios. It's a really powerful tool that and it'll really show you how the options are impacted by changes in implied volatility, changes in time, changes in stock price. Okay, so this is the thing with options. There's a lot of moving parts to options, and the more that you understand how all these option moving parts work together, you'll have a better understanding of how it affects your overall options pricing. So I know that was a lot of information. So once again, for more information regarding this presentation or basically any other presentation that we may have, you can always reach out to us this is our website, optionseducation.org. You can sign up for a free online account. and view our online course curriculum, view our podcasts, our videos, our webinars. We've done multiple videos on just about any subject that you can think of, whether if you want to learn more about calendar spreads or butterflies or straddles, strangles, you name it. We've done multiple videos on just about any subject that you can think of. And the best part of this offering is it's 100% free. So if you ever have questions, you can shoot us emails at options@theocc.com. We're always more than happy to help you. I work on a desk with 3 other very talented individuals, and collectively we have well over 100 years of trading and brokerage experience. So once again, we're not registered advisors, but we're always happy to answer your questions regarding the product. So we also have a YouTube channel that you can check out for free where we archive many of our past webinars. Right now, we're doing about 2 webinars a month on one single subject. So if you want to see what's coming up next for our webinar series, you can go to our website. I think one of my colleagues is talking about VIX or volatility futures and ETFs on the next webinar, which will probably be, actually, it'll be tomorrow. So if you have interest in that, you can always go over to the website, see what the schedule is, and sign up for free. And with that, that's the end of the presentation. So I know we have a little time left over. I'm gonna bring back Natalie, and if there are any questions, I'd be happy to answer them for you.
Yeah, thank you so much, Ken. We are right at our hour mark. That was a ton of great information. I'm going to remind everyone to copy down the contact website and email and social links that Ken put up here for you. We did have a couple of questions during your presentation, but you kind of answered them just now. One was, this is first a compliment to you, Ken, that the information was fantastic. So thank you for that, as always, and asking where they can find out more. So again, I'll direct you to Ken's screen right now. You can go to optionseducation.org and find additional presentations from the OIC at your leisure. And as a reminder, we are recording this afternoon's presentation, so everyone here and everyone who signed up but didn't join live will get an email tomorrow from info@tradeagt.com, and it's going to have a link to the recorded replay of this entire session, so no worries there. As I said, we are right at our hour time here, so if anyone has additional questions or questions pop up after the fact regarding this presentation, please either reach out directly to Ken and his team at options@theocc.com or shoot us an email at info@tradeagt.com, and we can direct those questions over to the OIC if needed. We're getting a lot of comments coming in here, Ken, saying thank you. Thanks for the great information. So as always, it's fantastic to have you, Ken, and to be able to share all this amazing, detailed, very clear step-by-step information with our audience. And I like how you went through that new OIC calculator. That was pretty cool. That's a new update.
Yeah, it is. I mean, so our tools are kind of upgraded. So we have that. We have a historical and implied volatility tool to kind of like you can map out, how expensive or cheap your options are at any given time. One thing that's not on there that's probably going to come up in 2025 is we just partnered with a third-party firm, and we're going to be offering an options simulator sometime in 2025. So once again, this would be entirely free. If you sign up for a free account, you'll have access to the simulator. I'm thinking that it's probably going to be available maybe first or second quarter of 2025, but you'll be able to actually paper trade your favorite stocks without committing actual capital and put on condors, butterflies, crazy 1x5s or whatever you want, and have it there and see how the market, actually test your ideas and your strategies before you actually commit real capital, which will be something that we used to have a long time ago. It was no longer compatible with our trading platform or our platform, but we're going to reintroduce it. So yeah, it's going to be.
Oh yeah, that's exciting. That'll be a nice additional add-on for
Absolutely.
Sure. Excellent. Very cool. Very cool. Well, yeah, we look forward to seeing that. And as always, I'm going to continue to invite you back to present to our audience. We'll get you back here sometime in the first quarter. Would be great. But thank you as always. We love to have you. I hope you have a wonderful holiday season. as well as everyone here live in the Zoom room. Whatever you celebrate, I hope you have a wonderful season, and we will see you back at the next Avant Garde Trading free educational webinar. Thank you, everyone. Have a good rest of your day.
Thanks, everyone. Thanks, Allie.